Hello friends, welcome to day 2 of final revision for AFM pass first time. So today we are going to discuss reconstructions and reorganizations, right? This area is an area I would not say most difficult, because if I say most difficult then you will be in panic mode, but yes, it is an area which is least out of all the other areas. This area is performed not so good. It is least performed, right? So this area is not performed well compared to your risk management or your net present value investment appraisal and your acquisition and merger. That is the reason I thought of bringing this topic before the other topics, right? So before I show you the type of questions which can come in this uh, section, this is the section D of your syllabus, corporate reconstructions and reorganizations. Unlike, as you have seen my day 1 video where I posted of risk management, all the areas which you have to learn, the questions there were very standard, exact methods we have to follow. We know the type of question which can come, so we are like we can like kind of predict. It is predictable, right? So according to that we can kind of plan also our ideas and all. We know when future comes what to do, when option comes, find number of contracts or do all those steps, and the way it is asked displayed also is very similar. Contract size will be given, a table will be given, so it's like that. But coming to reconstruction and reorganization, a key thing is this question is not standard. Like this question from this area does not come in a standard form. Question varies a lot, question can come in any form, so that makes this topic a little you I would say you cannot predict. Any question can come from anywhere. So to solve that doubt and to make this concept a little easier so that you get the starting easier, I have categorized 5 points, key points, 5 types of question which is asked in reconstructions and reorganizations. Just pick up any past paper or your revision kit and see. You will see this pattern. I have identified this. There's a trend. This is the pattern. The questions might not be standard. It could be asked in any way. Agreed. But at least these 5 areas. Out of this five, at least one or two will be asked in one sitting, right? So starting with that, as you can see on your screen, there are 5 areas. Impact on income statement, number one. This is not to be followed in an order, okay? I'm just giving in that these are the 5 key areas which you need to remember when it comes to reconstruction and reorganization. Number one, income impact of reconstructions on your income statement. They will give you an income statement. So what you have to do is they will give you an income statement, right? You have to copy paste that income statement, and beside that, aside of that, you have to write the impact. Write the impact means change the figure. What would be your revenue? What would be your profit before tax? What would be your profit after tax? All those things, right? So that you have to that's easy, pretty much easy, right? It sounds easy, but to show that impact is hard. You need a lot of workings to do that. I will show you in the questions. So first is impact on income statement. I have given you the examples also, as you can see, very famous examples. PAT and EPS. What is this PAT? PAT is profit after tax, and EPS, earnings per share. So you can see they tell you what is an EPS after reconstructions and before reconstructions. You just have to compare for that comparison purpose, right? Whether your income statement improved or whether it didn't. So you have to comment. First, you have to show that table and write your figure and show the and discuss what is the impact. For example, you saw that your EPS before reconstruction was 0.31. After reconstruction, it is 0.35. So now you can make a comment that EPS improved because of this reconstruction. Maybe your earnings improved. Why that improvement or why that decrease? You have to explain that also. Let's say EPS increased after reconstruction. So you have to say EPS increased after reconstruction. Why? Because of two reasons. It is possible because of two reasons. One is earnings, one is share. Either your earnings increased or your share reduced. So your earnings might have improved after reconstructions, or your number of shares reduced. You might have cancelled off some shares. You might have increased your debt, right? So these are the reasons you have to give. Coming to second point. Second is impact on balance sheet, or in other words, financial position. They will give a balance sheet. You just have to show the impact, change the figure, like income statement. And mind you, your income statement and balance sheet, they are linked. There are some figures which is linked. For example, your profit after tax, that return earnings, whatever earnings is there, that will be carried forward in your balance sheet, right? So they both are linked. So it is same like your income statement, the impact you have to show on balance sheet. One of the key figures, okay, this they would ask is this gearing and FS figure. FS means financial position figure. I'm sorry, it is FP, a financial statement. Yeah, so financial statement figure and gearing. How your gearing improved or it got worse. These questions will be asked. So you have to be ready for this, because these are very common questions. Commonly they ask you impact on income statement, balance sheet, income statement, balance. Sometimes, most of the time, it is both they will give income statement and balance sheet. Both you have to show the impact. But sometimes you must have seen only income statement. You have to show the impact, or sometimes it is just the balance sheet. Okay, so coming to the third point, recalculate cost of equity, cost of debt, and WACC, and then compare before reconstruction. Here, it is not your reconstruction. What is this third point? This chapter links to what? This point links to which chapter of your syllabus? Which section? Section B, Advanced Investment Appraisal, exactly. Because there only you studied cost of equity, cost of WACC, and all those things, right? You have to apply it here also as well. This cost of equity, cost of debt, or WACC is important throughout the syllabus. It can come either as investment appraisal, it can come in your mergers and acquisition, it can come in your reconstructions also. The only area where it does not come is in your exchange rate risk management. Your risk management chapter, it does not come. But definitely, you might get a question on acquisition or merger, you might get a question on reconstruction, or you might get a question on investment appraisal. So in any way, in either of the way, you cannot skip this cost of equity, cost of debt, and WACC. You have to know how to perform it. It is simple, right? They will clearly specify find cost of equity and WACC. So the areas here is what? Cost of equity, cost of debt, WACC. And sometimes, mind you, one thing. Sometimes before the reconstruction, they might not give you what is the let's say cost of your WACC is not there. You have cost of equity, yes, but cost of debt and WACC is not there. Or you have one figure but the other two is missing. Or you might have two figures but one is missing. So first you have to find before, sometimes, right? Most of the time it is before reconstruction also you have to find out. And after reconstruction also you have to find out. And then compare whether it increase or decrease and comment. So this is the flow. These are the steps. Of course, you cannot find after reconstruction before you find before reconstruction, right? So it makes logical sense that before reconstruction only you have to find all these three figures. Sometimes cost of equity is given before reconstruction. So then don't go again and find out cost of equity and waste time. It is already there. Carry forward and find cost of debt and WACC. But most of the time, cost of equity you have to find out, and cost of debt is most of the time it is given unless your debt is changed. If your debt is increased or reduced, then only your cost of debt will change. Otherwise, cost of debt is usually given. It's easy to find out. But sorry, cost of debt, cost of equity, yes, you have to find out. Coming to fourth point, impact on stakeholders. They will tell you this. In your report, you have to write. If not in your calculations, of course, some calculations or ratios you have to do. Otherwise, you cannot show the impact. For example, through your EPS, if you have calculated what is the EPS after reconstruction, you can show the impact on your shareholders. So these are some few stakeholders. Main stakeholders, shareholders, your debt holders, your bank or VC. What is VC? Venture capitalist. We all know that how venture capitalist is important in reconstruction and reorganization. Sometimes they will give you the facts about VC, sometimes they will not give you. So it depends on the case study. But shareholders and debt holders, definitely you have to give the impact. For example, let's say you have increased your debt. So that increase in debt, what is the impact on shareholders? Maybe gearing has increased, so it's not good for the shareholders because they are committed to paying higher interest, which can have a difficulty in their liquidity position and all those blah blah. Coming to debt holders' point of view, debt holders will be more concerned now if gearing increase, if we are not in a good position. So all these things, right? You have to write. Coming to the last point, impact on cash flow, a specific item of reconstruction. Sometimes for reconstruction, they will specifically tell you that what is the impact on this, what is the impact on this item. They will specify. That's why it was a specific item. I don't know what is the specific item because it differs from case study to case study. But cash flow, yes, impact on cash flow. They will tell you when you sell off this division, what is the impact on the cash flow? How much your cash flow will increase? So all these questions will be asked. For example, in bracket I've given sale of individual assets versus sale of entire division. Sometimes in one question also we have, right? Definitely reconstruction and reorganization is the opposite of acquisition and merger. So one good thing is whatever you have studied in acquisition and merger, apply in reconstruction and reorganization, but it is the opposite effect. There you are acquiring company and joining. Here you are dividing into two separate companies. From one company you are getting into two. How? Either you are selling your assets, individual assets, either you are selling off your entire division. In a company there might be 5 divisions. Out of 5, maybe 2 you are selling off. So that impact of selling the 2 division will be on the cash flow directly. So that impact you have to show. And another way you can sell off is not only by selling entire division. It could be MBO and MBI. Okay, let me write this. Sell division or assets is one way. Another way is MBO or MBI. Very common, very common. You have to know it. Management buyout versus management buy-in. Even the theory part of this you should know. What are the advantages, disadvantages, and how? MBO means you are giving it to your manager. You're selling off. So second is this. Third, it could be a demerger. What is the impact of demerger? What is the benefit compared to other? And finally, don't forget to show the impact on the remaining part. This question will be asked. Definitely, it's not just the impact of selling off that part. No, what is the remaining? Let's say you have one two division. One division is holding 70% of the investment, non-current assets. The other one is having 30%. So that 30% part you have sold off. You're receiving cash and everything. You show the impact also. Now, what is the impact of the 70% which is remaining for in your organization? That impact you have to show. So don't forget to show that impact of the remaining parts. Right? So these are some key areas. Now, if you want to summarize or if you want to memorize kind of thing, you can break down, you can make a, what do I say, questions. You can convert these sentences into questions. I would say 5 W's. Okay. Let me write it on the screen for you. So the 5 W's. What are the 5 W's? Number 1. What is the impact on the income statement? Sorry, don't mind my handwriting. I know it's bad, but you write it neatly so that you can understand. Second question, what is the impact on the balance sheet? So what, I'm not going to repeat this. What is the impact on balance sheet? Number 3, what is the impact on cost of equity, cost of debt, and WACC after reconstruction, of course. Number 4, these are 5 W's, okay, or 5 questions. What questions? Number 4, what is the impact on stakeholders? Number 5, what is the impact? Cash flows and remaining parts. As you can see now, isn't it easy for you to memorize now? Just remove that what is the impact. It is repeated, right? What is the impact? What is the impact? What is the impact? Just now see the keywords. I would use a different color pen. Wait a minute. Yes. So I would now use a different color pen. I would use black. Income statement, balance sheet, cost of equity, cost of debt, and WACC, stakeholders, cash flows, remaining part. So I break down into 1, 2, 3, 4, 5, 6, 7, 8 keywords. 8 keywords. Now you write it. Income statement, balance sheet, cost of equity, cost of debt, WACC, stakeholders, cash flows, remaining part. With this, you just have to add that question, what is the impact? That's it. So that is the whole thing. Now I have finished. I'm done. This is the summarization of your reconstruction and reorganization. Now can we go to the question and see? I'm taking you through the questions to see how this question has been asked multiple times in different sittings, different past paper. Starting with question 30 because 30 is your first question, right? This questions are from your revision kit. So 30, let me take you to question 30. I didn't copy paste the full question of because I have previously discussed you how we got the figures, and also my aim here is not to get the answer or show you that how to calculate this answer, just to show you the format and how question has been asked. So here you can see part A, they asked discuss the possible benefits of the Doric's part division being divested through a management buyout. Can you see this? Benefits of management buyout. Let me read the red is better, right? Yes. So benefit and management buyout. Can you see? Some part, okay? Some part, some division has been divested. Divested how? Through management buyout. Management buyout means it has been sold off to their manager, current manager. So what are the benefits of that? 4 marks. You have to be equally prepared for the theory marks. So management buyout, management buy-in. This is a key area where you have to know your theory part. So one, just mark it somewhere, write it. Theory parts to learn on management buyout versus management buy-in. Benefits and drawbacks. Coming to the second B part. Provide an estimate of the return of the liability holders and the shareholders. Can you see now? Return on what liability holders and shareholders would receive in the event that Doric is closed and all assets are sold. If it is closed and all assets are sold, what is the impact? Or what is the estimate of the return? That means how much they are going to get, liability holders, and how much shareholder is receiving. Another key area. Just now, previously I have told you, impact on stakeholders. If a division has been sold off or closed off or whatever. Coming to third, C. Estimate the amount of additional finance needed and the value of the new company. Exactly, value of the new company means what? The remaining part. The remaining part is a new company now. Because you are not merged with that company. That company is sold off. After that, what is the impact? This also I have previously told you. So estimate the amount of the additional finance. Yes. I have told you specific. What is the impact on specific? Or you have to estimate a specific thing. So this is one of that. Additional finance is that specific thing. Okay. Let me put it in brackets so that you can write it. This is also asked. Okay. If only assets of the free trust are division sold and part division is divested through management buyout. So here one, okay, fresh division is sold, part division is management buyout. It is sold through management buyout. So now briefly discuss whether or not management buyout would be beneficial. Again, they have asked about whether it will be beneficial or not. To answer this, you have to show through calculations. You cannot just write and tell. Coming to last part. Last part is a theory part. Okay, if you see, last part is a theory part. This is the type of question where you need to be creative. You need to think outside the box, because everything is not presented to you in your textbook, such as this type of question. At least one or two questions every year, it will be new, something new. You have never seen that type of question, but still you have to try to collect easy marks, maybe by defining, maybe giving some features of it, maybe you are giving some benefits, maybe you're comparing the two things, right? So Dorex directors are of the opinion that they could receive a better price if each division is sold as a going concern instead of as a sold separately. Sold as a going concern versus as a sold separately. They have been told that they need to consider two aspects when selling a company or part of a company. What is it? Seeking potential buyers and negotiating the sale price, or due diligence. Discuss the issue that should be taken into consideration with each aspect. One is about seeking potential buyers and negotiating. The other one is due diligence. You have to discuss both these issues. So this question, this type of questions, you have to think. You will not get from your textbook and anywhere. Neither your memorization of any memorization can help. Coming to 31. Okay, before that, let me show you the answer how 30 is presented. So 30, just see. Part A I haven't given because it is an theory. Coming to part B, just see the impact. What is the net proceed? Net proceed from the sale. Obviously, this will go to your cash balance, cash flow, right? And after that, how much your liability holders will get? This much. Shareholders will receive nothing, mind you. Remember this thing. It is not always necessary that shareholders will be getting something or liabilities. Sometimes shareholders receive nothing. Why? Because when you see that hierarchy, you should know that hierarchy. To whom? When a company liquidates, who is going to receive first? Your liquidity holders over the shareholders. Liquidity holders will be paid first. After they are paid all their due amounts, then the remaining will be paid to the shareholders. But if nothing is remaining, then shareholders will not receive anything. Like in this condition, right? And how they have received the 0.56 per $1, it is showed like this. Because they have received cash 156, their total liabilities was 280 from the balance sheet, right? Coming to part C. Part C, when fridge division is sold. Part is one division, fridge is another division. So this division is sold, and you have to find out the total funds required. And also you have to value this company. Just go through how they have valued. So when the total fund is required, just see, right? I have already discussed the answer, how you get the answer in my question 30, right? Revision kit solutions 30, question 30. So I'm not going to discuss all this figure, but yes, one thing I want to show you. Sometimes they don't clearly specify which division is which, like which proportion. They don't give you the proportion of the two division. Let's say part and fridge division. In this, they have told this fridge is 2/3 and part is 1/3. Clearly they told that. That's why it's easy, but most of the time they don't give you this ratio. Then how do you find out? Somewhere they will give you a hint. They will tell you that this sentence will be there. Okay, uh, that proportion will be find out by the value of the non-current assets. Value of the non-current assets of the two company. We have a question like that also, where proportion is not given. So we'll see how to find out that proportion, because finding that proportion is very important. Like how they have found 2/3. So it is not the whole amount, it is only that division's part you are taking. If you are taking sales, because in the balance sheet, when you see that balance sheet is for both the combined, both parts are combined there, parts and fridge. You have to separate out the two parts by using their proportion, right? So you have found out the total funds required. Next, you have been told to value. How are you going to value? You cannot use price earning ratio. See, there are many ways of valuing a company. You should know that your valuation of company techniques also. What are they? There are so many. We have price earning ratio method, right? This comes in market based. Then there's net asset based. Then we have your cash flow based, where we have a dividend valuation model. But can we use dividend valuation model here? Can we use the PE ratio here? No. Why? Nothing has been mentioned about PE ratio. Nothing has been mentioned about dividend. So how can you use it? Discounted cash flow. Cash flow. Cash flow method can be used because we know the cash flow. How? We can get the cash flow. Just see, starting with sales, deducting your cost, whatever the profit you have, then deduct your tax, and then cash flow before interest payment. We assume that your profit after tax is your cash flow. That is an assumption. So we are using cash flow to value. Cash flow in perpetuity, right? Free cash flow to firm or free cash flow to equity. One of these two method will be applicable in this. So you always have to see which method is applicable to your case study and use the method. Thus it is free cash flow, right? How they have valued this, the formula they have used. This over your cost of equity or WACC deducted by your growth rate, and you got 461. Now coming to part D. Part D, it is the theory part of due diligence, and that one I haven't included mentioned here. So now you have a clear idea, right? Better idea of how a reconstruction can come. Now coming to 30. Question 31. So 31, before I show you the answer, this is the answer. Let us go to the question. So this is the question. I haven't put the full question. That's why I'm just trying to show that this is how they will give you the income statement or profit or loss statement of profit or loss account, right? Just see. Starting with operating profit, going to return earnings. Then they have the statement of financial position also. So all this they will give you. You just have to change this figure. And then, mind you, some notes will be here. Very important is you take the notes, right? This tells you a lot of things. Who are the shareholders? How much each own? Who are your debt holders? How much each? Maybe your debt. Maybe they might have given your debt or long-term loan as 800. How this 800 is made up of? Maybe 100 from bondholders, 200 from loan, 300 from, there are so many debts are there. So it is given in under notes. Then coming to this, after the details of the proposed refinancing, this will be given to you. Through this only, you can show the impact on your income statement and balance sheet. How? Just see, there are 4. We can see here the loan note is replaced by the shares. That means loan note will be cancelled by that amount, 5 million, and will add it with your shares. So share will increase, loan will reduce. You can see the impact. Here they would subscribe VC. Gupti VC is the venture capitalist. They would subscribe to additional 20 million shares. That means their shareholding will increase. Right? Directors are going to invest additional 50 million shares. Again, share will increase. This 8.95 bank loan, currently the bank loan is this much. And also the borrowing will increase by this much. Expected finance cost is given to you. So this is the way a proposed refinancing plans will be given. We have further down. Non-current asset will increase this much. Operating profit will increase this much. Coming to this, just see the requirement. First part, prepare a projected statement of financial position. They have given you the date also. On the assumption that they exercise is right, that means venture capitalists will have their shares increased and their shares are repurchased and cancelled by float. 4 marks, just 4 marks. But how many workings are there? Coming to C, prepare a projected statement of financial position. I've told you what is the impact on the financial position. The same date. Coming to third, project a statement of profit or loss. So this and this might look same, right? Project a statement of financial position, project a statement of financial position, but the difference is here you can see it is on the assumption that they exercise is right. So he is the principal here, the main I think. But in the next one, on the assumption that the proposed refinancing and investment takes place, full, refinancing and all takes place. This is only on the impact of GUPT VSC. Next, coming to B, evaluate whether the suggested refinancing scheme is likely to be agreed by all finance providers. Whether it will be agreed, this is a common question, key question. Agreed by all finance providers means you have to show the impact on the finance providers first. You have to show the impact, then only you can tell. If the impact is good, of course they will be happy to accept. If it's not good, they might renegotiate the terms or try to change and all. State clearly any assumptions. Assumptions here is also very important. In reconstruction and reorganizations also there are assumptions. Okay, coming to 32. Oh wait, let me show you that 31 answer. Just see here how they have given you the, when you see your main cash flow, you will see that this cash is not there, right? This will be included, okay? Most of the, right, 100% cash will be there after your reconstruction. It will not be there in your original financial position. And also your return on share capital will change. So these are the places where the change will occur. Non-current assets, sometimes bank loan, right? Now, second, when full refinancing takes place, just check the amount, compare. Here it is 69 only, non-current asset. That means your non-current asset will not change from your original. It will remain the same because our focus is only on GUPT VC shares. That means share will change, right? Share will change, and what else will change? There's no cash, no impact on cash. And also what is the other thing? Retained earnings. Retained earnings and cash, these are the two things which will change. Others, everything will remain same. Because when you see here, asset increased. Can you see? Because this is now full refinancing. That's why asset increased. Now we have cash also, and cash is a balancing figure. Otherwise, your balance sheet should balance. If your balance sheet does not balance, you are incorrect. Now, if you see your share capital increased, before it was how much? Oldie 40. Now it is 90. And here, if you see no loan note because of that refinancing, and your long-term liability increased 65. Before, how much it was? Before it was 35. We had loan note and we had bank loan. Now loan note is cancelled because of full refinancing. So this is the impact. This is how you show the impact. Come into this projected. For 2007 also we have, 2008 also we have. Then now you're discussing what is the current situation. Starting with the current situation. Always start with the current situation first. Then you talk about reconstruction. Right? So purchase of this shares. Then we are coming to the shareholding. Shareholders, when you have to show the impact, whether they will agree or not, this is how you have to get the percentage. You have to get their percentages first. This working has to be done. What is it before? Right? Current means before. After refinancing, if you see here, from 27.5 to 42.5, shareholder directors, this thing increased, percentage reduced, but in terms of percentage you should know how to find, because before we had 50. So that means 27.5 over 50 will give you 55%. You should know that how to find that in terms of percentage also. Because why you have to find in terms of percentage? Please make it a habit of finding in terms of percentage. The reason is, when you're taking it in terms of number of shares, one thing can go wrong is, see here it is 27.5, here it is 42.5. Clearly we can tell it is beneficial, but if you're seeing the percentage terms, now you know it's a decline in percentage, which is not good. Why? Because here when you're taking this 27.5, it is out of 50 shares, but here this 42.5 is out of 90 shares. That's why that the percentage has to be there for you to compare. That's why this working is there. Right? Here, This also 25.5, this is also 12.5. It remains same. So this can be misleading for you if you're not writing in terms of percentage. Here it is 25, but here it is 13.9. Oh my god, such a drastic decline, which is not a good sign. That means it shows that you can see that directors, maybe they will accept, maybe they will not, because the reduction is not so much, but other family members, yes, they have a very high chance of not liking this, not accepting this proposal, because their shareholding reduced drastically. Gupti VC, if you see Gupti from 10 to 20, their shareholding also increased. That means what? The current shareholders will not be happy with this, because their power, venture capital is shares holding is increasing, means they will have a power. They can have an influence over the board. Coming to the loan note holders, before there is nothing, no loan holder. Now they also have 5.6%. So this table, this working helps you to do that. Because here, when you're talking about shareholders, it is directors and other family members. When you're talking about loan holders, it is the loan holder. Right? So position of the finance providers, you are writing this, as you can see. Coming to 32, we'll go to the questions. Another thing is, they will give you different types of proposal. That means a reconstruction can be done in many ways, not just one way. And it comes in different proposal. Proposal 1, proposal 2, proposal 3. What is the impact? So when they give you different proposals, this type of question specifically, I have seen that they tell you to show the impact on the balance sheet of the three proposals, impact on the income statement, income on the gearing, EPS, like that, of the three proposals. This type of question is very common, right? Here, proposal 1, borrowing is increasing. Buyback share capital. Buyback share capital means your shareholding will reduce. Share will reduce. That reduction of shareholding, you should know how to work. In reconstruction, if you don't know how to work out the cancellation of shares or reduction in shareholding when buyback share is there, or in other words, repurchase of share, if you don't know, your every calculation will go wrong. Because shareholding is very important, number of shares, what you put in your balance sheet. Proposal 2, if you see, here also, if you can see, borrowing increased, but investing in additional non-current assets. That borrowing which you are taking, you are investing in additional non-current assets. Third one, you are reducing your borrowings and selling the excess non-current asset. Sell excess non-current asset, but debt is reducing, right? Because it will use to that when you're selling, you're getting cash. That cash you're using to pay off your debts. That means your company debt will reduce. So these are the proposal, and you have been given the financial position, right? You have been given some information also. And here, this is the requirement. As you can see, estimate and discuss. So estimate means calculation, discuss means write in words the impact of each of the three proposals, as I told you, on the focus statement of financial position, and the focus statement of financial position, right? On the earnings. On the earnings means you have to find the income statement also, even though they specifically didn't tell you the focused statement of financial performance or income statement, but they told earnings. Earnings means you have to do that. And earnings, and then EPS, and then gearing. Make sure that you know the formula of earnings per share and gearing. Gearing is debt over debt plus equity. Coming to part B. Explain what the securitization process would involve and what the key factors to undertaking the process. This is a theory question. Right? Make sure what is securitization. So this is how the answer is. Just see. Always copy paste the current. Then proposal 1, proposal 2, proposal 3. If you see in proposal 1, there will be no change in non-current. So every place is not changing in your financial position. Only those areas where, for example, if you're increasing debt, only debt will increase. And share buyback, so your share will reduce. Everything remains same. Current asset, if you see, there's a change, reduction, because your cash will reduce. Rest all remains the same. Current liabilities same. Here non-current liabilities increased because your debt. Proposal 1 means your debt will increase. Now if you see your share capital reduced, right? I have explained this in my question 32 when I solved how that reduction in value to calculate. So I'm not discussing it here. Please go back and check that video. And finally your return earnings will definitely change because your earnings will change. This return earnings you have to take from your earnings calculation, income statement. This is why I tell you there's a link. In proposal 2, if you see, when you're taking proposal 2, don't compare from proposal 1. You have to compare like this with the current. Then proposal 3, with this you have to compare with the current. So if you can see from 282 to 300 it increased because you're investing in non-current. Here from 282 to 257 it reduced because the selling of current assets, non-current assets. Can you see the direct impact? Current assets will change in all the three because it includes cash and also your return earnings when you're paying off your debt or paying off interest. So it will be paid from current assets only. Next, but your share capital will remain same, 48,000, 48,000, 48,000. Only in this condition it changed because you are buy back the share. And your return earning calculation is down here, your earnings. Here also, it will be same. They have given you 26 million, it will be same. Rest all the workings like this. Under current, it will be 26 million only. Your workings will come in proposal 1, 2 and 3. For example, if it's a okay, if debt is increasing, where will it impact? Interest. You have to pay higher interest. You have to pay additional interest also. If coupon is increased or something. Then there's interest saved also if debt is reduced. Right? If it's a lower coupon, interest will be saved. If you are investing in assets, there will be return. If you are selling off assets, there will be return lost. Then there will be profit also when you are selling non-current assets. So all these adjustments will change your total assets. Now coming to gearing part. Right? Gearing is what? Non-current over non-current plus equity. So this will be same. This you can take from the balance sheet. Right? From the balance sheet, you can take your non-current liabilities and equity and find the number of shares. So that's it. Coming to 33. This is the answer. I will take you to the question first. Yes, the question applies here. See, you have been given some extract of the income statement, a balance sheet. This is profit after tax from income statement. Rest all is from your balance sheet. Here, clearly they have told you 70% is for supermarket. That means 30% is for the other division. Clearly they have given you the proportion. Right? And here they have given you the PE ratio. So this mentioning of PE ratio tells you that when you calculate the value of the company, use PE ratio. This is what it means. And finally, after the selling and all what they will give. Now you see the requirement. Advise them whether they should sell the division as a going concern or sell assets separately. And estimate the additional cash and debt funds which could be available to the new downsized company. Right? Next. Alternative to selling supermarket would be demerge. So they are telling it's selling off versus demerge. Whether you have to sell off the supermarket division entirely or demerge it. You have to tell the benefits and drawbacks. Discuss whether demerger of supermarket may be more appropriate than a sale. So demerger versus sale. Benefits and drawbacks you have to give. Coming to part C is about Islamic finance. Right? So just see how even in your reconstruction and reorganization, Islamic finance they are bringing out. So when they have to bring a theory part they can bring out anyhow. Right? So it's not like it is Islamic finance, it will not be asked. Why it is asked in this question? Because this question is about reconstruction and reorganization. See, everything from your section A, as I told you, section A is role of senior financial advisor. That is your theory part. This theory part comes in any section. It can come in your acquisition and merger. It can come in your risk management. It can come like this in reconstruction also. Right? And don't underestimate the power of theory. 12 marks. 12 marks is not a game. So please understand the value of theory, and I am confident now And I have this faith on my students that after knowing this, you will focus more on the theory part. 34. This is the answer. I'm suggesting, wait, 34. Yes, so first we'll go through the yes, so this is the question. I haven't copy paste. As you can see, every question till now, did you see any question where balance sheet and income statement is not given? You didn't see, you will not see also. Every question will have a balance sheet, every question will have income statement. So here also you can see as I scroll down, and also you have been given some things, how this will change, how what it consists and all. It is common only. Here also they have mentioned about MBO. Here they have talked about annual growth rate of dividends. That means something to do with dividend will be here in this question, right? Now coming to requirements. Distinguish between MBO and MBI. Right? Exactly what I have told. Discuss. How many times did you see this word MBO till now? At least 3 to 4 times, right? So it shows that this is a very likely area to be asked for. Discuss the relative benefits and drawbacks to the company if it is disposed to MBA instead of MBI. You have to tell the benefits to the company. 5 marks. Now 12 marks. Estimate showing all relevant calculations where the restrictive covenant imposed by default is likely to be met. Restrictive covenant. Restrictive covenant is something to do with bank loan. When they are putting some restrictive covenant, what is the impact? You have to show. Right? And last one. Discuss with supporting calculations whether or not an MBO. Supporting calculations means calculations is very small. It's just few calculation which is maybe a ratio or something. Maybe one ratio. The reason is for you to support when you are discussing whether MBO would be beneficial to the company. Okay, see here they are not saying as general. They are saying MBO would be beneficial to DOFO and UCASO senior management team. Specifically, they are telling benefit to whom. So you have to give specific benefits, not general benefit, like in part A. Okay, now coming to 34. Right, but something I have missed out. Just wait a minute. Yes, 34. So 34, sometimes you have to make for different years, right? As you can see, income statement. Then you have to estimate the gearing for the 4 years after MBO. Okay, here, how they have got whether it's covenant breach or not. Covenant means you have to find what? Gearing. Gearing means what? Gearing means equity and debt. Simple as that. So you have to find your book value of equity, book value of debt, find your gearing and what is the covenant. And with that covenant, see whether it is breached or not. They have told you that above some percentage it is breached. So here they are saying no, 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 and yes. In this condition, it is breached. Now coming to part C. Right? Here they have told part C supporting calculations, whether this would be beneficial to this or not. To know that, you have to, they have done two things. One is net asset valuation, one is dividend valuation model. Two valuation models they can use. Yes, it is possible that you can use 2-3 valuations in one if they have given you the figures for that. Like for net asset, they have given you the figure for net asset valuation. That's why you can use it. Right? Why you're finding this net asset valuation? To equity holders. To equity investors, you want to know what is the value, whether it increased or not. If value increased, it is beneficial. If not, it's not. So wherever they tell you with the benefit of MBO, you might think, see, coming to this requirement again, part C, read it again. Discuss with supporting calculations whether MBA would be beneficial to do for, and this one, senior management team. So this question is likely to be misinterpreted by the students and they would have started writing theory part. But if you see, there is a huge calculations there, supporting calculations, right? So beneficial means value of the company. Value of the company by using the methods. So one is they have used net asset and they have got this value. Next, they have used dividend valuation model. Yes, clearly they have given you the mention about the growth rate and the dividend and the cost of equity. So you can find the dividend valuation model also and find the value, right? Coming to 35, the last question. So here, no, this is the answer. Let me take you to the question. So the question starts from here. As you can see, they have given it the predicted cash flow. And when they are selling this club, what is the impact on the cash flow? They have given you the free cash flow. They have given you the rate of increasing. And also they have given you the WACC as 12%. That shows that it is free cash flow to firm, not equity. But if they tell free cash flow to equity, they would have given you the cost of equity also. Now, here, one thing. This question has cost of equity, cost of capital and WACC to calculate. That's why. The reason why I'm telling is they have given you this. When they have given you this point number 5. See, point number 5 is not to be taken in your balance sheet. They told you tradable debt is this much. It does not mean that in your balance sheet you're going and putting this debt. No, this does not come in your reconstruction. This comes as your WACC calculation or cost of equity and cost of debt. That's why they have given you this. The debt is this much, 10% loan note is this much, and the what is it? Overall pre-tax cost of debt is this much. Right? This information is there. They have also given it the risk-free rate and return. This is your CAPM. Why would they give you CAPM? Only in one condition, when you have to find cost of equity, cost of debt and WACC. So that is this question. And also again they have given you balance sheet. See, no question is there without balance sheet. And only 2 requirements. And there are 2 requirements for 17 marks. 17 damn marks. Calculate the expected sale price of EV clubs. So this is specific questions. Where specific item they are telling you to calculate. And demonstrate its impact. The impact of sale on EV's statement of financial position. So impact on sale of their financial position, focused EPS and WACC. WACC includes cost of equity and cost of debt also. Even though they don't ask separately, but yes. So there are so many things you have to calculate. That's how the 17 marks is distributed according to 4 things. Statement of the expected sale price, statement of financial position, EPS, WACC. 4 areas. Coming to B, evaluate the decision to sell. Evaluate the decision to sell. Yes, this is a theory question, but it is linked with this. And it's for 8 marks. It looks easy. It's 8 marks is nothing, but it's very hard when you come to write. Evaluate means pros and cons. Whether you have to sell EV clubs or not. How are you going to say this pros and cons? You are basing your decision use your financial information, what you have just calculated. You can use your EPS, you can use the financial position, you can use your WACC. All these areas you can mention about each area, how it has improved or declined, and then say whether it is advisable to sell or not. So that's it for this reconstruction and reorganization. Again, I will take you back to this 5 key areas, 5 questions and 5 key areas. Your 5 W's, 5 what? Because every question starts with what. What is the impact on this? So let me summarize everything again and let me repeat what I have discussed today in the starting. Impact on your income statement, income on balance sheet, impact on your WACC, impact on stakeholders, impact on the remaining part, and also on specific items such as cash flow. So that's it. With this, I end this video here. Stay tuned to my channel to get the latest videos As soon as I upload them, for that you have to subscribe to my channel, you all know, and click that bell icon so that you get the notification. My next video will be about mergers and accusation, day 3. So stay tuned to my channel to get the latest video, which is day 3, an accusation and merger. Are you all guys excited? I'm excited too. Okay then, take care.